Describe the capital budgeting process and distinguish among the various categories of capital projects. Capital budgeting is all about identifying and evaluating capital projects, projects with a life of a year or longer. There are 4 steps to the capital budgeting process. Okay, step 1 is generate ideas. This might be the most important step. A business or a capital budgeting program isn't going to go very far without a good source of investment ideas. Step 2 is analyze proposals. This is an information gathering and calculation step. We're going to be forecasting cash flows, calculating profitability, basically putting together the numbers we're going to need when it comes to comparison and decision making. Step 3 is create the capital budget. This is where we piece the proposals together. It's important to remember that although an investment proposal may look good in isolation, all projects must be considered together in terms of how they interact and how they fit with the company's overall strategy. Finally then, step 4, monitoring and post-audit. In this stage, we compare the expected or forecasted numbers with the actual outcomes of the project or projects undertaken. This might lead to increasing the investment in the best performers and reducing or cancelling the ones that have not performed as expected. Okay, next we need to look at the categories of capital budgeting projects. There are 4 major categories you need to be aware of. Number 1, replacement. Now in this first category we have 2 subtypes. We have maintenance projects, quite simply a piece of machinery runs through its useful life and needs to be replaced. And then we have cost reduction projects, where we target a more efficient process. We're looking at removing a less efficient machine and replacing it with a new technology. Now both of these types of projects lend themselves to a very detailed level of analysis, meaning that we end up with less assumptions and more confidence in the forecast, so therefore we have confidence in the decision making. Number 2, expansion. Here, rather than buying a machine to replace an old one, we're buying a second machine. We're looking to increase the size of this business. Now obviously, since replacement projects pertain to business that is currently ongoing and expansion is about gaining new business, there is going to be more uncertainty inherent in this analysis, and that means a bit more doubt when it comes to the final decision. Number 3, new product. Now we're talking about doing something brand new for this company, stretching out into uncharted territory. Again, because the future is uncertain and we are not dealing with business that we are currently involved in, this analysis is fraught with potential uncertainty. There is a wide spectrum of potential for error here, and so, again, there is going to be some level of doubt when it comes to making the final decision. Finally then, number 4, a mandatory project. This is simply a project that we are required to undertake. For example, an oil company who is required to clean up a spill. These projects generally don't earn any revenue and in some cases can bankrupt the company. Describe the basic principles of capital budgeting. Now, although the process of evaluating investments and building a capital budget is no mean feat, there are a few major principles that underpin the whole discipline. In capital budgeting, decision-making is all about cash flow. We are not going to be thinking about depreciation, intangibles, or anything related to the calculation of accounting income. If there's a real benefit, there should be real cash, so we focus on cash flow when evaluating and comparing projects. As you should understand well by now, the timing of cash flow is key. A very detailed understanding of the schedule of cash movements is highly valuable in decision-making for capital projects, especially when you think of multiple overlapping projects. And since we are working with cash, it's no great leap to understand that tax must be considered. Since different projects will incur different levels of tax or bring about different tax benefits, tax will be a major guiding line in terms of analysis. And finally then we have financing costs. Now here you might be expecting me to tell you that there is no cost that can be ignored, that we must factor in the cost of capital when considering whether or not to undertake a project. No. Remember that all after-tax cash flows that we forecast in this analysis of a project will be discounted at the required rate of return to calculate an NPV. This discount rate will include a factor related to financing costs. If we were to include financing costs in the cash flow analysis, we would actually be double counting for financing costs. Okay, now before we leave this section, there are a few other terms here which are important to consider as part of your understanding of the capital budgeting decision-making process. Sunk costs are costs that are irretrievable even if the project doesn't go ahead. If, for example, we are comparing Project A to Project B and we have already spent €100 million on a marketing plan for Project A, we might be tempted to include that 100 million into the comparison. That would be wrong. That 100 million is gone. We need to focus on the future. Just because we have already spent €100 million doesn't mean we should stick with Project A. It might be more profitable to turn the boat around and go with B. Opportunity cost is an amount reflecting the value of a resource in an alternative capacity. A simple example is the capital used to buy a new machine. If we can project with some level of certainty that a brand new €3 million machine is going to produce inventory worth €10 million over its useful life, then that sounds pretty good. But maybe we could invest the €3 million somewhere else. How much could we earn in a low-risk bond investment? How much could we earn in a higher-risk equity portfolio? These possible uses for the €3 million investment are called opportunity costs, possibilities we have foregone to go ahead with this chosen project. With incremental cash flow, we add cash flows we expect to receive because a path was chosen, and we remove cash flows we expect to forego because other paths were not chosen. This is a useful basis for making capital budgeting decisions as long as the opportunity costs are properly assessed. Finally, then we have externalities. Here we are talking about the effect of a choice on other areas. What effect will this decision have on other elements of the company? For example, if we are running a pencil manufacturer and we decide to design a new pencil with an eraser stuck onto the end, how much will that affect sales of our original product? Similarly, if a bakery chose to harvest, mill, package, and sell their own brand of flour, how much will that benefit their cost structure on the baking side? These are things that a business must consider when we talk about externalities. Explain how the evaluation and selection of capital projects is affected by mutually exclusive projects, project sequencing, and capital rationing. Mutually exclusive projects cannot be chosen together. If one is chosen, the other must be forgone. Independent projects, on the other hand, can be chosen together. If they are both desirable projects from the company's perspective, they can both be undertaken. If we undertake a project today, we assume that it will be profitable. Project sequencing is the idea that if a project is in fact profitable, we will reinvest in another project. On the other hand, if the first project is not as successful as we had planned, then we may not be able to invest in the second. Finally then, capital rationing. This is the harsh reality that we may not have endless amounts of funding available to undertake any and all available profitable projects that come about. With a fixed budget, we need to choose the projects that have the highest and most likely levels of profitability. What decision will result in the highest overall increase in shareholder value from the capital we have available? Describe expected relations among an investment's NPV, company value, and share price. With the wording of this LOS, you would have to be forgiven if you expected to see some pretty complex mathematical or conceptual ideas here relating a project's NPV and the share price of the company undertaking that project. Fortunately, at level 1, this area is actually quite simple. All we need to do is take the company's capitalization prior to the project, add the NPV of the project, and we end up with the capitalization after the project. We can simply then divide that figure by the number of outstanding shares, and we have the expected future share price. A company is planning to buy $100 million worth of new machinery to expand their operation. We have analysed the project, forecasted cash flows, and come up with a present value of future cash flows of 145 million. Given that this company has 20 million shares outstanding with a current market price of $10, what will be the company's stock price if they go ahead with this expansion? Let's fill out the formula. Pre-project capitalization is just the market price times the number of shares outstanding, which we are given as $10 and 20 million shares. So the pre-project capitalization of this company is $200 million. For the project's NPV, we simply take the present value of future cash flows and remove the initial outlay, 145 million minus 100 million, so $45 million. And finally then we sum these together to get the post-project capitalization as $245 million. Now we have been told nothing about a share repurchase or equity issuance, so we can assume that the same 20 million shares are outstanding at the end of the project. If we divide the 245 million by 20 million, we get the post-project company share price as $12.25.